India's capital goods sector is currently on track to maintain 12 to 14% revenue growth through 2027, driven by a global shift in manufacturing and a domestic clean power transition. The financial commitments are concrete. The national infrastructure pipeline has reached 213 trillion rupees, supported by over 2 trillion rupees in dedicated manufacturing incentives. But there is a frequent disconnect between these government outlays and the actual returns in a retail portfolio. This is the primary risk of the 2026 market. Macroeconomic headlines provide a roadmap for where the money is going, but they offer no guarantee that your specific stocks will capture it. Mistaking a broad industrial trend for a sound individual valuation is how investors end up overpaying for growth that never reaches their bottom line. Public information about the EV transition or green hydrogen is usually reflected in the stock price the moment it hits the news. By the time you act, that growth is already priced in. Chasing momentum based on a budget announcement often means buying at the top of a hype cycle when the potential for further profit has already been exhausted. Successful investing in this environment requires shifting your focus away from the sector itself and toward the underlying financial reality of the companies within it. To identify true wealth compounders, you have to audit 3 specific areas: the company's competitive moat, its debt levels, and its current valuation. Long-term wealth is built by sticking to these 3 metrics, even when a sector headline is tempting you to ignore them. Take the manufacturing shift. The government approved over 800 applications for the production incentive scheme, attracting global smartphone and semiconductor assembly to local plants. These subsidies create an immediate surge in top-line revenue for local contract manufacturers. That contract manufacturing is inherently difficult. These businesses must constantly reinvest their cash into equipment and facilities while operating on razor-thin margins. This is why a competitive moat is vital. Without proprietary technology, these companies cannot protect their profits. If you invest in a manufacturer lacking a moat, global competition will erode their margins the moment those government incentives expire. Infrastructure shows a similar pattern. Order books for large capital goods companies reached 5.2 lakh crore rupees, a 50% increase over the last 2 years. For players like NCC or IRB Infra, these contracts provide visibility into their future earnings. However, building roads and bridges requires continuous borrowing. This makes the debt-to-equity ratio your most important filter. A ratio above 0.3 signals the company is taking on too much risk. A massive order book becomes a liability if project delays force the company to use its earnings just to service its debt. The National Electricity Plan projects that solar and wind will drive 66% of India's generation growth through 2032. This creates a significant need for grid storage and pumped hydro to balance the system when the sun isn't shining. But green technology is moving quickly. The systems being installed today face a high risk of becoming obsolete before they even pay for themselves. Because the technology changes so fast, you cannot afford to overpay. Strict valuation discipline is the only way to manage this risk. If you pay a high premium today, you are betting their current technology will remain relevant and profitable 5 years from now. To navigate this, you need a screening process separating market sentiment from actual business value. Demand a clear competitive advantage, a debt-to-equity ratio below 0.3, and a stock price that hasn't already factored in 5 years of perfect growth. Honestly, sticking to these requirements is difficult. You will have to ignore most of the stocks people are talking about, watching from the sidelines while speculative names rally. But avoiding those rallies is the price you pay for security. It's the only way to ensure you survive the inevitable corrections in these cycles. Real wealth is generated when you find the rare company that combines a strong industry tailwind with a healthy balance sheet. If your goal is trading short-term news surrounding budget updates, these fundamentals will slow you down. In momentum games, retail investors often provide the liquidity that institutional investors use to exit. This strategy is for investors with a 10-year horizon, willing to wait. Using a systematic investment plan helps you manage the volatility that is natural in these high-growth sectors. In the 2026 market, the most reliable way to grow your portfolio isn't to follow the crowd to the next big sector. It's to ignore the hype and audit the balance sheet.